Welcome to the Power and Market Report. I'm Albert Liu. My guest today is John Williams, the publisher of Shadow Stats Newsletter, an electronic newsletter service that exposes and analyzes flaws in current U.S. government economic data and reporting. John, this is your first appearance on the Power and Market Report, so a very warm welcome to you. How are you?
I'm very well, thank you, and thank you so much for having me on your report.
You're very welcome. I want to start just with a brief introduction, since this is your first time. Can you tell us a little bit about your background? What background do you have, and how does that qualify you, or why do you have such a good understanding of the process of government data collection and government statistical reporting?
Well, I've been a private consulting economist for more than 30 years now, and it was actually I cut my teeth in the chainsaw business. Family business that imported product from West Germany. I was educated in the area of economics. Went to Dartmouth, took business school, got into econometric modeling there, and I got into taking really a new approach to forecasting basic economic activity using leading indicators to drive econometric modeling. I got my business off the ground. One of my early clients was a large manufacturer of airplanes, and all of a sudden their model of the GDP, or I guess what was on the GNP, the broadest measure of the economy, had stopped working, and as I got into the detail, I found that there were some severe problems with the trade statistics, major component of the GDP, which we still see knocking the numbers all over the place quarter to quarter. I corrected the numbers, and the government corrected them a couple of quarters later, and the model started working again. But as time went on, I found that increasingly the models and the relationships were not holding up as they once had. And this largely had to do with the government shifting its reporting methodology in a variety of areas. Over time, the economic numbers tended to be changed so that there were upside biases built into the economic growth or into the employment growth, and with the inflation, the numbers were revised so that, or the methodologies were revised to reduce the reported rate of inflation. So much so that the numbers out of the government went very much contrary to common experience. I was getting a lot of comment from people that they didn't believe the strength of the economic statistics or the low rate of inflation, and as a result, I found myself becoming a specialist in the government reporting, how they compiled their numbers, how they changed the reporting of their numbers, and began publishing estimates of what the numbers would have been without all these methodological changes that I'll contend were largely political in nature or had other forces behind them, such as the inflation numbers, or a lower inflation rate would help the government balance its budget deficit by cutting such factors as Social Security, annual Social Security cost of living adjustments, or pushing people into higher tax brackets, and thus increasing revenues, decreasing expenses. Government doesn't give you a CPI that is meaningful from the standpoint that the average person looks at it. What I found over time is that Main Street USA has a much better sense of where underlying economic reality is than the government statistics. And so I found myself basically assessing the government's numbers from that perspective, and looking at business cycles in a way that probably more closely match most people's experience in terms of business activity up and down, then you get out of the headline reporting.
Okay, let me jump in here for a second, John. You've certainly found a niche for yourself, and many people with your background and your skills are drawn to the, let's call it the dark side of the force. We really appreciate people who have been skeptical of the numbers, certainly appreciate the work you do. So let's just jump in here right away and look at the October jobs numbers. So we had a number come out a few days back. It was interpreted as being strong, at least the New York Times interpreted it that way. They had a headline, "Strong growth in jobs may encourage Fed to raise rates." That's a useful, I think, tool for the Federal Reserve. So the stock market obviously pulled back on that. They're saying we had 271,000 jobs, higher than expected. What's your first reaction to that number?
Nonsense. There are two primary surveys that the Bureau of Labor Statistics uses in assessing labor conditions. The headline jobs growth, which you just cited, comes out of the payroll and employment survey. Government surveys businesses. They measure the number of jobs. Doesn't matter if they're long-term or, full-time or part-time. If anyone works an hour in the survey week, they're counted as employed. Over time, that system has been built up to increase monthly reporting with upside biases. Back in the 80s, and I was talking with people at the Bureau of Labor Statistics at the time as to what they were doing. They introduced what they called a bias factor, very straightforward, where they were adding in 120,000 jobs a month into the a monthly payroll gain. And I asked them why they did that, and as they explained it to me, that they always did their best in terms of reporting, but it was politically embarrassing if they underestimated the employment growth, and that happened coming out of the 1983 recession. For a variety of reasons, they did come shy of counting jobs that were being created, and so they added in a bias factor just to prevent that from happening in the future. And that bias factor was added in year after year. Now, once a year, they'll go back and they'll go through a benchmark revision. They'll count companies that are paying unemployment insurance and estimate people that are working based on that, and so that they would adjust the numbers a year later. Normally, you'd get a pretty big downside revision in the numbers each year to adjust for that upside bias. As they got some increased criticism over time, they modified the process and made it what they now call the birth-death model, where they try and estimate the jobs that are being created by new companies that they can't survey, or where they don't get survey information, versus the loss of jobs from companies going out of business. And they always assume there's a positive jobs creation, even though when you go into significant economic downturns, it turns negative. That's what circumstance we've had here. What we've seen in the last couple of years has been extraordinary. So right now, they had close to about 800,000 jobs per year, but that's on top of other assumptions. Overall upside bias is in excess of 200,000 jobs a month, and I'll contend that's not real. So you see a jobs gain of 271,000. That's probably closer to 70,000, and you have a margin of error around that, plus or minus roughly 130,000. So effectively, the jobs number as reported was not meaningful. And that's usually the case.
That's incredible, John.
I'm sorry?
That's incredible. So basically, they're taking advantage of the fact that people really pay attention to the headline number. The revisions sort of get buried in the noise.
Well, the revisions once a year you get revisions, but they've gotten more creative. I mean, for example, they've announced that for this year there's a downside revision of 200 and I think it's 208,000. It's in excess of 200,000. Little shy of what I would have expected. They had something that order of magnitude last year, but they did unusual things when it came to the revision and actually increased biases instead of reducing them. But there's a big factor here that throws off those monthly numbers, and very few people follow it, and it becomes disastrous when you look at the unemployment rate.
Okay, I want to move on to something else, if I might,
Sure.
John. So first, we're saying the numbers are inflated as they are, just
Yes.
creatively through upward adjustments or biases. There's also the fact that we're kind of essentially in a recession in the resource market, mining, energy, and those jobs, mining, energy, and manufacturing, declined 4,000. And it's actually the hospitality, leisure and hospitality sector where like 40,000 or so, if you believe the number, jobs were created. Can you comment on that?
Again, you have biases, and they allocate the biases in each industry. I would put really very little significance in terms of the month-to-month change there in the data. It's I mean, if you look at the last revision, I forget all the areas that were involved, but it was pretty much across the board. Some places they revised higher, some places they revised lower. Look at the numbers that have been strongest in the last year, and those are probably the areas that got the biggest downside revisions. We're not seeing an economic recovery. We haven't. We never really pulled out of the downturn in the economy that hit hard after the end of 2007, where the economy crashed into 2009. You see it in a number of indicators. You don't see it in the payroll numbers specifically, but here again, this is you look at the payroll data. The labor numbers are, in theory, a coincident indicator of broad economic activity. They're not a lagging indicator, as some people claim. It used to be a coincident indicator in the government series where they published coincident indicators. And what you'll see is that where the GDP crashed into the middle of 2009, it has since recovered and is now 10% above where it was before the recession. That recovered in 2011. Payrolls, as you see them, didn't recover until 2014. But even there, where they're now up rather significantly, what you have to consider is that the payroll jobs are not full-time employment. What happened with this downturn is a lot of people who had full-time employment lost it. Best they could do is get a part-time job. So that you had a lot of the gain in the payroll has been in people taking on more than one job or 3 jobs. Doesn't matter how many jobs you have, but each job is counted as employment in the payroll survey. If you look at the other survey, the household survey, where they count full employment, that's full-time employment. The people who are full-time employed, the level there is flirting with with recovering its pre-recession high. It's a little bit above it right now. Last month it was below. It's been up and down, up and down. The economy, the labor market is not as strong as you'd suspect looking at those payroll numbers.
Okay, so yeah, to your point, the average hospitality worker is working somewhere between 20 and 25 hours per week, not bringing home a lot of weekly income, and many of them are forced to take more than one job. So that's a good point. I want to move on now to CPI, other government statistics. So CPI, money supply, those things. You publish shadow statistics on your website. And
yes.
So when I first discovered you, it's probably been about 10 years ago. For people who don't realize how much the numbers are finessed, this is a real eye-opener. So what you've done is, I'll I'll let you explain it, I guess, but for, let's say, inflation, for example, the CPI, the government's saying the CPI is what, point something, 0.2, maybe less?
Well, it's, right now they're looking at basically zero year
okay.
over year.
And your shadow stats, I'm putting up two plots for the viewers. One is 1980 based shadow stats, and the other one is 1990 based shadow stats. These are somewhere between what, 4%?
So between 3.5 and 7% differential. And I don't go in and recalculate all those CPI. What I do is I look at the changes made to the methodology, and what the government has estimated that the changes to the methodology, how that has changed the annual reporting of the CPI. Almost all the changes have tended to reduce the annual reporting of the CPI. That's deliberate. And since 1980, it's about 7.5 percentage points. And since 1990, it's about 3.5 percentage points. And where they've hit it, this is probably the most egregious thing that's been done in the government's numbers. The average person looking at inflation, what do you want to know what the rate of inflation is? How is that useful to you? Well, in terms of determining what should happen to your income, ideally you'd like your income at least to match inflation, hopefully to beat it, so that you're gaining on inflation and able to improve your living standards over time. From an investment standpoint, you want to be able to get a greater return on your assets than the rate of inflation, so you're not losing value net of inflation. You're not losing wealth net of inflation. Up until the 1980s, and there have been consumer price indices around for centuries, the concept very simply was measuring the cost of living of maintaining a constant standard of living. You use very simplistic terms. They'd measure, let's say, the price of a pound of beef, a gallon of gasoline, a loaf of bread. They'd price out that same basket of goods the next year. Whatever that basket of goods had gone up by a percentage, that's how much your CPI, your cost of living, went up. In the early 80s, they started changing the way of calculating quality adjustments. A whole new concept there. Bureau of Labor Statistics always goes and adjusts for quality where it's measurable from a financial standpoint. They go around and they survey, and the surveys find 1 month you have an 8-ounce candy bar. The next month it's in the same size package, but it's a 6-ounce candy bar. They adjust for that, and they should. That's you're not just so you're getting the same value for your money. But when they have a quality change that cannot be measured financially, that a person doesn't consider as being a change in their out-of-pocket expenditure. If the government deems there to be a quality improvement, they'll reduce the pricing in their measure. A real simplistic one, a very simple one. They've actually reversed doing this for future conditions, but it gives you a pretty good idea as to the concept. Some years back, the government mandated a change in gasoline formulation that would improve emissions quality. And when it went into effect, the price of gasoline went up 10 cents per gallon at the pump, which in those days was a rather significant increase. Yet that did not get added into the consumer price index because it was deemed by the government to be quality improvement. Yet from the standpoint of the guy pumping the gas into his car before going to work, he was moaning and groaning. It's going to cost him more to go to work. He was looking at his out-of-pocket expense. That's the way most people look at their expenses. So where the consumer wasn't looking at, well, boy, I've got better air coming down the road, he wasn't able to make his stretch his income as far as he used to be able to, because this happened. They made these changes, but there was for someone who's living on a fixed income Social Security, they didn't get an adjustment in the consumer price index to help compensate for that. So that
John,
was.
if you can I jump in for a second? If I look at the
Yeah.
two charts side by side, so I have your 80s based and the 90s based, you can really see how the effect of going to the 1990 based alternate really masked the massive increase in inflation we had over that decade.
Yes, you did, and that was largely in this what they call hedonic quality adjustments. So that's probably that's a better part of it. But the other part that comes after 1990 is where you get comments from people such as Alan Greenspan explaining why this is happening or why they're changing things. Because what he noted, and as did Michael Boskin at the time, who was then at is the head of the Council of Economic Advisors, said, the consumer price index overstates inflation, and if only we had a more realistic consumer price index, one that was lower, it would save us a lot of money. And again, as I mentioned, that where they'd save the money is cutting cost of living adjustments on Social Security, where they have some kind of an inflation escalation in tax brackets. People would find themselves in higher tax brackets with a lower rate of inflation. So that what they did, I mean, if you ask Greenspan, what do you mean the CPI is overstated? He'll say, if the price of steak gets too expensive, people are going to buy more hamburger. And if they buy more hamburger, then their cost of living isn't as high. Well, by his definition, and again, we're talking definition here, he's right by his definition. On the other hand, that's not a consumer price index that's based on maintaining a constant standard of living. I prefer steak to hamburger personally, and I would like if I'm trying to figure out what it's going to cost me to live, I would take that into account. So that you had added in after the 90s a circumstance where they tried to shift the consumer price index to a substitution-based index. They never fully did that, but they did all sorts of things to mimic it, and that's the balance of the shift there. They have also now introduced and have had in place for some time what they call the chain-weighted CPIU, which is being designed and groomed as a new cost of living measure that will be used for Social Security and such. They've been doing all sorts of things to expedite its reporting so that it can be done on a timely basis. That'll knock another percent off actual inflation. When I say actual, by my definition, the way an individual would look at it in terms of his or her needs, and being able to match or to determine what the cost of living is for maintaining a constant standard of living.
Okay, I'd like to move on now to unemployment. We talked about it at the beginning of the show, but you actually publish, again, Shadow Stats Alternatives for Unemployment. So I'm going to show the viewers one of your charts here. So you show basically headline U3 unemployment going back to the early mid-90s. And you can see that number is trending down. It's around 5% on this chart. And then you have U6, which is inclusive of other factors, up at 10%. What's really astonishing, though, is your last line, and that is the shadow stats, which my understanding is takes into account long-term discouraged workers, up over 20%. Can you talk about that?
Sure. Well, first of all, what you see there in 1994 and after, back in 1994, the government redefined its unemployment survey. And again, we're talking a matter of definition. The headline unemployment, the government actually publishes 6 levels of unemployment. U3 is their headline number. That's for the one that dropped from 5.1 to 5.0% on this last go round, which is really a rounding difference from 5.05 to 5.04. Those numbers actually are not comparable on a month-to-month basis. the government works an outright fraud in the reporting there. They use what is called concurrent seasonal adjustments. You need to seasonally adjust numbers because as you have different business seasons, you'll have employment rise and fall. Let's say with people being employed at Christmas time at the retail stores. But it used to be that would just be done on a one shot basis for the year, and then again you tend to revise the numbers. Every time with the concurrent seasonal factors, what they do is they calculate a new set of seasonal factors every month, and with the current, when they figure out the current month's seasonal adjustment, that resets the entire history. But the Bureau of Labor Statistics only publishes the current month on a consistent basis. The prior month's number that was based on a different set of seasonal adjustments is not revised. So that what you're looking at are numbers that are not comparable. So anything that you see here that says that you're up or down anything shy of 0.3%, it's meaningless in terms of significance. But that's just in terms of the month-to-month change. In terms of the level, in order to be in that headline U3 unemployment, you have to have looked for work in the last 4 weeks. If you've had a rough time getting a job and you haven't looked for work in the last 4 weeks, they count you as a discouraged worker, and they'll track you and they'll keep you in their numbers for a full year. But you're counted in a broader measure. The broadest one they have is U6, which includes the people who've been discouraged for a year, plus people who are working part-time for economic reasons, meaning they can't get a full-time job, and that's where you get 10% versus 5%. The U6 is at 10. The headline number's at 5. But after a year, they no longer count you as discouraged. Well, back before 1994, there was no time limit on being discouraged, and there's a little broader definition as to what a discouraged worker was. But the effect is that they made the changes at the time of NAFTA, where you had the plant closings in Ohio and plants being moved to Mexico. Towns that had a one factory circumstance, all of a sudden you're having people that were long-term unemployed, and if they stayed there, they were not only discouraged workers for a year, but it went on well beyond a year. They couldn't get a job. So that with the headline numbers, if you stop looking after 4 weeks, then you're dropped from the headline payroll. And what's terrible here, I mean, it's unusual, but we had an extraordinary economic slowdown. Most of the improvement that you've seen in the underlying unemployment rate has not been from the people who are unemployed getting gainful employment. I mean, that's happy times, normal economic recovery. People who are unemployed get back into the workforce, get back into the active workforce. They get jobs, and the unemployment rate drops. What's happening here instead is that the drop in the headline unemployment, that U3, largely has been due to people becoming discouraged workers and dropping out of the labor force. And the way the unemployment rate is calculated, that actually reduces the unemployment rate because the employed part of the labor force. The labor force is just the employment plus the unemployment. The employment's so much larger that as you drop people from the labor force at the same time as you're dropping them from the unemployment rate actually goes down. So most of the times you've seen these headline monthly declines, unemployment rate drops by 0.1%, whatever. That aside from assuming it's comparable, what you'll see with the numbers is that it's because people have been dropping out of the headline labor force. And Janet Yellen, who talked about the headlines, oh my goodness, this is going to stimulate a rate increase. um, she looks at a number called the participation rate, and that is at an historic low. I know here it's the lowest since 1967, whatever. The numbers before 1994 are not comparable with what they put out today. So, for all intents and purposes, anything that's the weakest since 1994 is an historic low. So, what happens though, again, is that you see the people who move out of the headline unemployment rate. At least they go into the broader unemployment rate. But after a year, they drop out of that. And as this economy has slowed down and it has not recovered, you now have people they're leaving the broader measure and are no longer counted in the even amongst the discouraged workers. What I do is I estimate those that are discouraged the way that it used to be pre-1994. And so that when someone drops out of the U6 unemployment rate, the broad measure is not dropping because same effect as you have with the underlying rate, the headline U3 rate, and that is that people are just dropping out of the labor force. I still count them, and my estimate is that if you went around, asked everyone in the country today whether or not he or she was employed or unemployed, most people can give you a pretty good answer on that without thinking about it. That you'd get a number much closer to mine, which is right now at 22.8%.
Okay, 22%, John. I just a general question actually, because you're not doing these surveys, so I assume you're taking what data you can from government publications, and then if there's data missing, you're somehow inferring figures. Is that right? For instance, CPI and unemployment. What's the confidence factor you have in the number that you publish?
Okay, well, there are different approaches with the different measures. With the CPI, that's based on the government's estimates of what the different changes of cost in terms of the headline inflation. Now, there are a couple of areas that the government doesn't consider to be methodological, so they don't estimate, and I've had to make an estimate there. But of the 7.5% a total from 1980 on, about 2% of that would be my estimate. In terms of the unemployment, again, I've been working in this area for more than 30 years. There's a fellow by the name of Al Sindlinger, no longer with us, but he was an old-time consumer pollster, and he hated to be called a pollster. He was put into business by Herbert Hoover after the war, doing what became consumer confidence surveys. Although he did it a different way than you see with the conference board and such. Although he ran the conference board survey early on, but he had, shy of the government's numbers, the broadest surveying I saw done privately, and I got close to Al and worked with him some in his numbers, and looked at the changes made in '94 and the effects that the change in the discouraged workers had. So there were things based on that and other private surveying that I've used in my estimates of the long-term discouraged workers, but I do work off the government space there. So it would be, I'm comfortable with the number I have out there, but it is my estimate. It's not the government's estimate, and it does. I do things that the government does not do with its numbers on that.
Okay. Final question for you with the time we have left, John. I want to talk about money supply. This is somewhere where you make a big contribution. The government stopped publishing M3 sometime back in like 2006, I believe. I have the chart here.
Right.
Yeah, you've continued M3 with your shadow stats. And what's interesting about this is you see, a big peak in the percent change right during the crisis, and then it comes down. We take a bit of that out in the 2010, 2011 time frame. I guess the first question is that the giant peak in M3. What do you attribute that to? Is that something like asset-backed securities showing up in money market funds, or what? Where did that big?
Well, that was largely it. What you have to keep in mind here, and I still don't fully understand why the Fed stopped tracking M3. Actually there were earlier numbers such as what they used to call L with liquidity, which included private holdings of Treasury bills. But the M3 was for a long time was their broadest measure, and they said that they were discontinuing it for several reasons. One, it was too expensive for them to track and report. The other was that really they didn't get any more information out of it than they got out of M2. And
clearly, that's not the case. If you look at the chart,
that's all nonsense. Because the money, the numbers I get together to put together M3, I get from the Fed. They still track everything.
Right.
What happened was, I mean, we consider with M1 is basically that's just the cash in circulation, demand deposits, checking accounts, travelers checks. Then you get to M2, that's M1 plus basically time deposits, small time deposits, money market funds, such. M3 was M2 plus, and the biggest factors there were institutional money funds and large time deposits. Well, if you're going to continue to track the small time deposits, why not track the large time deposits? They track them, but why not report it? So that what you saw happen was with the financial crisis and the near collapse of the banking system, a lot of money moved out of the institutional money funds and the large time deposits, and people went to cash. So you saw it jump up in M2, where it was either put into accounts in M2 or M1, but the relative level of M3 sank because the cash was shifting out of the M3 accounts into the lower accounts. That's all it was.
Yeah,
and now
that's interesting. Okay, so
bouncing back and forth a little bit. We've seen some unusual activity recently. All of a sudden, the broad money measures beginning to slow down, and some are M1 and M2 in tandem. Not enough to get too concerned about, but they are all moving in the same direction at the moment, which is towards slower growth.
Okay, so one interesting point or observation is that you see the two giant peaks in M1, one in 2009 beginning and another one around 2012. This looks to me like basically bank deleveraging. Is that your read?
Something along those lines, yes.
Yeah, okay. And then finally, you see all of the lines converging to about 5%. What is the most important takeaway in your view of basically the unpublished M3 converging with M2 and M1 in terms of the growth rate?
Well, it might be suggestive of some renewed confidence and stability in the banking system, but I don't think that's the case. I'm very concerned about what's happening with the Fed and their inability to raise interest rates. That's nonsense. The Fed can raise interest rates any time that it wants, and they're not concerned about the economy. I say they're not concerned about the economy. Of course, everyone wants to see a strong economy. But there's very little the Fed can do about it. They know that. Bernanke was rather explicit on that. And where you have in mind, or need to keep in mind, that the Fed always talks about its mandate from the Congress to keep unemployment down and inflation contained. The primary function of the central banks to keep the banking system afloat. And that was not happening back in 2008, the crisis there. Extraordinary things happened. The system was on the brink. The Treasury, the Fed did everything in their power to prevent a systemic collapse. They were successful, but they bailed out whoever they had to bail out. They created whatever money they had to create. They guaranteed whatever deposits there were. They did whatever they had to do to keep the system afloat. And none of the stuff that was done really addressed any of the problems that had brought the system to the brink of the collapse. The economy is still in trouble. There's still liquidity problems in the banking system. That's improved some, but there's clearly still problems there. The federal government really has not done anything to address its long-term solvency issues, the deficit in terms of what you might look at it on a generally accepted accounting principle basis, a GAAP basis. And I think what's happening now, the quantitative easing, all this money that the Fed supposedly created, and they did create it, but they bought the treasuries basically from the banking system. The banking system now had a lot of excess cash. Instead of lending it into the flow of commerce, which would have increased money supply growth, would increase lending, and might have helped the economy more, the banks put the cash back with the Fed, and they were paid interest on the excess reserves. The quantitative easing largely was a covert bailout or help for the banking system. It was done under the cover of a weak economy. Oh, the economy's weak, increase quantitative easing. That was their political cover, and that's maybe backed them a little bit into a corner, because now they want to increase interest rates, but the economy's not showing the type of strength that you'd expect. Where it's recovered, and the GDP is 10% above where it was before we went into this nonsense. If the GDP were that strong, there'd be no question as to the economy strength. The Fed can't figure out where the economy is. They're scared of something. They don't want to move. They don't want to move, not because of the economy, but there's something there that has frightened them. I think we're still living with the ghost of the financial panic of 2008. They're not quite sure what's going to happen there. It's a very dangerous and unusual time, has been for some time. But the economy never recovered, and that's not, at least not as advertised, and that has set up all sorts of problems that you're beginning to see unfold now.
John, unfortunately, got to wrap it up here, but just with a few seconds I have left, answer this question. Are we actually in a recession right now?
Yes, and it's one that should be recognized formally. It may be still another couple of months, but look at industrial production. You've had quarterly production, quarter-to-quarter contraction first, second quarter, but third quarter is flat. You had an unusual spike in auto production. Year-to-year growth is a level that's always given you a recession. You look at revenues of this S&P 500, the revenues, the sales, quarter-to-quarter, year-to-year, they're down, they're negative. That never happens outside of recession. You look at retail sales adjusted for the government's understated inflation. And there are a lot of funny things that happen with understated inflation, because that tends to boost the real or the inflation adjusted number. But even as published, we're seeing growth patterns here that, again, are consistent with the onset of a recession. I'll contend that a recession started in what will be recognized as a new recession started in December of 2014. Back in the collapse that went into 2008, 2009, it was timed from the end of 2007. That wasn't recognized till the end of 2008. It's going to be a couple of months, but you're going to see increasingly here that the negative trends are going to continue. They're going to deepen, and again, we're seeing patterns that are consistent with a contraction in real economic growth.
Okay, John, we're going to have to leave it there, but thank you very much. My guest has been John Williams, publisher of ShadowStats newsletter, and please check out his website at shadowstats.com. He's got a great primer there on government statistics. I remember going there some time ago, but it was just a fascinating read, so please check that out. John, it's been a great conversation. I really thank you for coming on the show, and I hope we can do it again. You're welcome anytime.
Well, I look forward to it, and thank you, Albert. Appreciate your having me on your show.
Thank you very much. And don't forget to visit powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing. John Williams. Until next time, take care.